do like to start off every show with kind of a summary of what we've seen happening in the market. So it's been a couple weeks since we've had the show, and I didn't do a summary last week. Last week turned out to be the best week since November of last year.
Yeah, maybe we should take time off more often.
I guess so. And it was an amazingly strong recovery week. This week's been pretty decent also actually, and if you look at the chart here, obviously we've got a lot of data up here with the pandemic drop, and then the big run up and the fall for the inflationary period in 22, et cetera. But if we look here at the very end, you can see that we're making another V recovery. Okay,
Yeah.
those are not that common. If you look at that chart, you can see some, but they're not as common as kind of the more testing new lows and kind of come up a little bit and then fall back down and come up a little bit, fall back down. Sort of like what we had last summer was much more typical.
Yeah, a couple months of more of a deterioration of the market.
Yeah, we could still be in for that. We have not set a new all-time high here yet or closed above that. We're within, less than 1% from doing that. Hopefully we'll do that, next week or what have you, because that's an important point. We don't want to get right up to the top here and then fall back down. You kind of get this double top thing going, right, which the market would be concerned about. So I do think it's important. So yesterday, we had a 1% drop in the middle of a really good week, actually green all the way across except for yesterday. So there's some concerns that, hey, are we making a double top? And, we'll have to see until you get through. You have to wait. But if you look at kind of what's happening altogether in terms of the primary trend, going back to October 13th of 2022, which is where that first arrow is, every low that has been coming along has been higher than the previous low, including this last one. If that one is the one that holds, we'll have to see. We're still kind of waiting to see if that's a low. You need to reestablish an all-time high to kind of call that, but I put that arrow in there anyway. And so this is what we're waiting for, is kind of getting through that line to kind of get moving forward as far as that goes. So, there are some very specific things driving the market right now that are very important. And I think, sometimes the market just runs, and you get almost like this tulip mania, and it doesn't really make sense. And those are the scarier markets for me. Certainly the end of the 2000 market was just like that. It was just running to run, sort of a momentum piece. The PE ratio got way up there, like 45 times earnings. Right now we're in that kind of 18 to 20 times forward earnings, projections, which is not cheap, but not that expensive either. It's kind of closer to the average. So if we look at kind of what's going on in the kind of the overall trends, our hourly trend went from red, which was turned red July 18th, back to green again on August 15th. So we always take a look at it, break down into pieces. So you're going to see your downturns come first in that hourly chart.
Yep.
Doesn't mean it's going to translate to anything. Matter of fact, that one didn't, right? But eventually, then all of a sudden, you got a daily chart that's turning red. And that's your primary trend has just changed there. And so the hourly is more of kind of an early warning signal. We do use it sometimes for new cash coming in. We'll wait until that thing turns green, because we don't want to buy a falling knife and come in, and have somebody's new money just turn into a 2008 downturn or whatever might happen, right? So we want to be a little careful. And then the market breadth indicators, looking at all these different ETFs, there's 8 different ETFs there. They haven't changed actually since we started this on June 3rd. Still have all green except for transportation, which is currently in a primary downtrend. Transportation is actually pretty close to turning into a primary uptrend, so even that one might turn green here too. So again, strong market. These aren't meant to be early warning indicators, these breadth pieces here. It's just more of confirmation of how bad this trend is getting, that type of thing. So you can kind of be aware of kind of what's happening across the spectrum. Is it just your stocks, or is it just the, sectors that you're looking at? What about the whole thing? How's that doing, right? And some of the major sectors that drive the market. So that looks good, right? That looks great to me, along with the chart being so strong. So the big thing probably this week, I believe, is really a couple of things that has to do with the Federal Reserve. So the Federal Reserve has a dual mandate, right? Keep inflation, in this case, core PCE inflation. And this chart goes back to the 1960s because there's some interesting history here. keep inflation at 2% or less. So right now it's at 2.63%.
Yeah.
And they'll be reporting it here next week again for
Yeah.
July. We'll see. I think the projection is around 2.5% for July year over year. So that would be nice. So you can see what happened here. We had a big period of time here with inflation being quite low. But this Federal Reserve has specifically mentioned that big chunk of inflation that happened earlier in this chart back in the 70s and early 80s.
Mm-hmm.
And what happens there, if you look, it's kind of interesting. What they're worried about is that first big bump that was in the late 60s, kind of coming down, started to come down by 1973, started to get down there. And they started to lower rates because the job market got softer. And then we had that spike straight up. And Chairman Powell specifically has said that they don't want to be a Federal Reserve that ends up doing that.
Yeah.
And so they want to keep the rates up for longer. Now, the difference, in my opinion, and why they need to be careful was, at least in my opinion, a big portion of that spike had to do with energy prices, oil prices going up. Oil prices went up from $4 a barrel to $40 a barrel in a 7-year period in there. And so if you think about it right now, if we're at 70 something dollars a barrel, if it went to 700 and something dollars a barrel, you would have an inflationary spike.
Yeah, a lot of people feared that with the Ukraine situation, that
Yes.
kind of inflationary spike.
Yeah, we went to 130, but there was people calling for 260, 250. They thought this would happen, and there were some reasons to be worried about it because Russia produced 11% of the world's oil. And I think the reason that we're at 70 is, first of all, the U.S. is a net exporter of oil now, so we can kind of, let stuff go out to the rest of the world that needs it, specifically Europe. They were the biggest customer for Russia. And then, Russian oil still probably got out there in a lot of different ways. And matter of fact, it might have got out there at even cheaper dollar amounts, kind of at a discount, which maybe keeps the other prices down too. So nonetheless, I don't think we're going to have that same piece. And so the focus, the other mandate that the Fed has is employment, what they call full employment, which, is around 4.1, 4.2%, someplace in that neighborhood is what they're looking at for the unemployment rate. So they really don't want like 1% unemployment. Because then you got a tight job market and that causes inflation. So they do allow a certain amount of unemployment because that is healthy for the economy. It's not healthy for those people that are unemployed and those families that are dealing with that. But that's kind of how it works, and that's what they're looking at. And so this is the job market, okay, the number of jobs. There's currently 158 million people in the U.S. working, okay? Non-farm, total non-farm payrolls. And you can see it's actually, every time there's one of those gray lines, you can see the dip, right? That's a recession. So there's layoffs in a recession, unemployment goes higher, right? But overall, pretty darn good path, right? Really moving along nicely. And even, I'll zoom in a little bit here to see more close. So this is just from the 2008, you see that gray line there, downturn to today, essentially. So you can see, obviously, the big drop that happened during the pandemic. We had a 2-month recession in there, and we ended up with 22 million less jobs. So at the peak there, it's 152 million, and at the bottom, it's 130 million. So 22 million jobs disappeared just, overnight, essentially. And so that's a pandemic. Now we're at 158 million jobs. We're actually above, where we were at the pandemic, which is great. However, one thing that strikes me is how unbelievably smooth and consistent that line is coming out of the 2008 downturn.
Yeah, it's just a steady growth up.
And that is through several different, that's Obama's second term, Trump's term, so it's different parties and, everybody's going to take credit for different things. But nonetheless, if you look at the long-term chart, job growth happens here in the U.S. pretty well. And so, but one thing, if you draw a little line on there, although we are moving, you can see we're starting to curve a little bit in there.
Yeah, it's slowing down.
We're not on track for being where we might have been prior to the pandemic to kind of get back up to that line. And so this is the key thing that the Federal Reserve is talking about now is, and so today was the Jackson Hole speech from Chairman Powell, right, for the Federal Reserve. And market dropped 1% yesterday in some concern. almost all of it's coming back so far today.
Yep.
We'll see what happens by the end of the close. But what they were talking about was that they're seeing some softness in the job market, and that it's time to make a change in the way that we're doing things. So they've been on hold basically since July of last year when did the last rate increase, and now September 18th is coming. And in his speech, he talked about. I think he hinted towards a half a point rate cut, depending on the August job report.
Yeah, I read something similar. Is if August is very softer, then
Yeah.
they're going to go for a bigger cut.
Yeah, exactly. So their meeting is September 18th. We'll get the jobs report prior to that on a Friday, probably the second Friday, so something close to that meeting.
Yeah.
So they'll have that data. And so, we're looking at a half to a quarter point, probably rate decrease in September. Market likes that. All right. And so that's the big news, is that we've gone from kind of focusing on the inflation itself to now focusing on the job market. And that softness in the job market is making, the market at the beginning of August here worry about possible recession.
Yeah,
Right?
people are fearful for their jobs. I know, like right now, it's spiking and people being scared for being laid off.
Yeah, exactly. And so that is the new shift. Now, we're pretty far from recession if you look at almost any measure that I can see. There's lots of predictions of recession indicators out there that have pretty good track records, but they don't include a pandemic. And that's what's kind of changed things here, is just this whole pandemic situation where consumers have continued to spend. So that's kind of what's happening. Market is very, very strong. We're making these V recoveries, which is really unusual, at least in my opinion. The strength is there. I'm having a hard time, though, seeing that strength continue just straight through the end of the year without any real hiccups or sideways motion or softness or 10% drops or whatever might happen. Only because we're in a presidential year. In a presidential year, the market makes more than average, 11% in the second half, right? Which is probably double average. But if you look at the stats, it's not even, right? September and October are soft months as people wait to see what's going to happen with the election. I mean, like in 2020, September, I think it dropped 9% and then came back, and October dropped 10%. And then we had the election, and we ended up with a good year. I mean, so what happens after the election, November 5th, is the market's most likely going to go up, as has happened every other, no matter who wins, just because there's money that was kind of sitting on the sidelines, that was not going in September and October, that now comes in now that we know the scenario, because there's different strategies that you might do in terms of investing depending on who wins. So maybe you wait for some of that. And whatnot, and so that's comes, and so oftentimes you'll have just a great stock market run, from the election to the very end of the year. But I'm having a hard time seeing this great run that we're on right now continue all the way from now to the election. We'll see. I have actually been probably too pessimistic, which is saying something, because I started this show just to ballyhoo optimism about what was going right out there, even during the pandemic. However, I'm more used to these kind of downturns like we had last summer, where it takes a couple months, kind of jumps up a couple times, and it fails, and it finally finds a bottom, and then we take off. But this market has just been so strong, we haven't had that. We've had these V recoveries. So who knows? Maybe we just keep on running all the way through the end of the year. That'd be great, as long as we don't get so far ahead of ourselves that we end up with an overpricing situation, which then requires a big sell-off to kind of take that steam off. So, we'll see. I am expecting good results after the election, just based on almost every other election I've ever been involved with in my 37 years. And actually, I'm at 38 years now. I got my license originally in August 17th. All right, so that's what's happening here as far as I'm concerned. It's a great time to be an investor, really, to be out there. We're seeing lots of rotation things. Small caps running today, but it wasn't running for quite a while here. It ran back in July. There's things that are rotating around quite a bit. It's a good idea to be pretty well diversified with most of your portfolios and kind of own everything, in my opinion, in these environments where things are rotating so quickly. Utilities are great, and then they slow down a bunch, and real estate's pretty hot right now, for whatever reason, and how long that continues, it's hard to say. So we do little pieces in our targets where we move into those areas of high momentum, but most of the money we try to keep in these big, wildly diversified, pieces, so that you can kind of capture this movement no matter what. Because overall, you just want to be in the market, right? You don't have to be in the thing that's going the highest, the fastest. That'd be great, but oftentimes if you miss that, you miss the whole market move. So you do want to have your money in the market as a whole, and then maybe play around on the margins if you're going to do that. Would be my opinion. Is what we do. All right, so that's our summary for the week for what happened. I look forward to being able to talk about this again next week.